Welcome to the first lesson. I will cover the main terms that are used in Forex trading. The purpose here is so that you are familiar with them or at least have heard of these terms. Then in the following lessons, you will see how this terminology is used in a live trading environment. So the first term is currency pairs. Pretty obvious. There are three types and they are categorized based on popularity. The 8 most frequently traded currencies are called major currencies, and you can see them listed here. Next, we have the minor currencies, the middle group, and the least popular are the cross currencies. So again, it's a sliding scale based on popularity. So you can trade any of these, and when you set up MetaTrader for the trading platform, you will see where to find these currencies. When you see a currency pair, they will be quoted like this. So you can see US dollar and Swiss franc. The base currency is the first currency. It shows how much the base is worth against the second currency, and the second currency is called the quote currency. Next, we have pips. Any currency movement is measured in pips. Pips are on every chart measurement. You will use pips to measure your orders and size of orders. It's like the way to navigate through your charts using pips. Depending on the currency and the broker you're using, you will sometimes see pips, other times you will see mini pips, or known as a pipette. It's 1/10 the size of a pip. Again, you will see this in action later when we jump onto our trading platform. In Forex trading, there is a large potential to make money because you are trading using your broker's money. When you buy a currency pair, you do not own it. This is not like going to an exchange and physically changing your US dollars to euros. When you buy a currency in Forex, there has to be a corresponding sell to complete your order. This is because in Forex you trade using leverage. For example, for every $1 you trade, you could potentially have $100 at your disposal. This would mean that you are using a 1-to-100 leverage on your trades. The positives are that you can earn a lot of money as you are trading with larger sums. The negatives are that you could lose all your money by using your broker's money. However, there is a safeguard to prevent this from happening, and I will share this later. Different brokers offer different leverage for trading. It can be even as high as 5000x leverage, although this is too risky. When you are starting, I suggest you use a leverage of 1-to-20, as it's not too big. You need to learn the mechanics of trading first before taking a risk and trading with larger leverage. To make trading with leverage possible, your broker will require a money deposit known as a margin, and then you can set your leverage. This money deposit is known as your margin, and margin is simply a portion of your funds that your Forex broker set aside from your account balance to keep your trade open and to ensure that you can cover any losses. It's the equivalent to security when getting a loan. Essentially, you are borrowing money from your broker in order to make larger trades. For example, if you have $100 in your account and you are trading with $1,000, so 1-to-10 leverage, the broker takes a certain amount from $100 as the margin for that trade. When the trade is completed, you get back your margin. If you are trading with $1,000 but your account only has $100 in it, if the trade goes against you, your entire account can be wiped out. So how do you safeguard yourself from having your account liquidated if your trade goes bad? The answer is by using a stop loss order. This is an open order that is a number of pips away from your entry price. If this stop loss is reached, your position will be exited and you will only lose a predetermined amount. So what is this predetermined amount? It's your risk ratio. When it comes to Forex trading, each position you enter represents a risk to your account balance. So if it goes against you, you lose a certain percentage of your account. For example, if your account is $100 and you are risking 5%, then your stop loss will be placed at a level that if it is hit, you lose $5. A generally acceptable process is to use a risk ratio of between 1-to-2% of your account. Now the reality is, when you're trading, you sometimes hit consecutive losses. And if you're trading at a 10% risk ratio and you hit 5 losses in a row, then you are down 50% of your account. If, however, you are using a risk ratio of 2% and you have 5 consecutive losses, then you are down only 10%. So this is a safeguard and stop losses should not be treated lightly. Now let's talk about lot sizes or position sizes. Forex is traded in specific amounts called lots. When you place an order to buy a currency, it is specified in lots. The standard size lot is 100,000 units of a certain currency, but there's also a mini, micro, and nano lot sizes. Some brokers show you lots, while others show actual currency units. Depending on the lot size, each pip will have a different money value. When I go to the trading platform MetaTrader 4, then you will get familiar with lot sizes and placing orders. And then we have the broker, and a broker is a company that is handling your account and through which you are trading Forex. Forex brokers will quote you two different prices for a currency pair, the bid and ask price. The bid is the price at which you can sell the base currency. The ask is the price at which you can buy the base currency. The difference between these two prices is known as the spread. Instead of charging a separate fee for your Forex transactions, the cost is built into the buy and sell price of the currency pair. So the broker makes money by selling the currency to you, and the broker also makes money by buying the currency from you. The difference between these two prices is the spread, and it can be known as the fee for trading. And a couple more Forex concepts here. As you are using leverage, you can buy and sell in Forex transactions. When you buy, it's going long. When you sell, it's going short. And when trading Forex, you can select the time frame that is most suitable to your trading style. So you can trade, say, 5-minute charts, 15-minute charts, or if you want to have a more long-term strategy, you can trade daily charts. But more on this later. Don't worry if this seems like a lot to take in. The first lesson is meant to introduce you to the terms, and the following lessons you will see how everything fits in when you start Forex trading. By the end of this first section, you will become familiar with these terms, I can promise you that. Okay, let's move on.